The bank where you do everyday banking, probably the worst place you can get a mortgage. I know, that sounds crazy. But here's the thing, most Canadians don't realize the big banks that you trust with your checking account are leaving tens of thousands of dollars on the table when it comes to your mortgage. And today, I'm breaking down exactly which lenders have the best mortgages in Canada and which ones you need to avoid. Before we dive in, I'm Dion Williams from Williams Mortgage. I work with Canadians all across the country, helping homeowners get mortgage free faster. If you want to chat, click the link below and book straight into my calendar. And while you're at it, hit that subscribe button so you don't miss any updates. Look, getting the right mortgage is probably the single most important financial decision you'll ever make. And here's what the banks won't tell you: having your mortgage where you do everyday banking doesn't improve your mortgage situation. It doesn't improve your banking situation either. What it does, it makes the banks more money and gives you fewer options. So today, we're comparing the big five banks against what we call monoline lenders, lenders that specialize in mortgages. And I'm going to show you exactly which ones give you the most flexibility, the lowest penalties, and the best chance to pay off your mortgage faster. But here's the thing most people don't know: those specialty mortgage lenders that your banker might call B lenders, they're not B lenders at all. In fact, you often need better qualifications to get approved with them. And the irony, most lenders are funded by the big banks anyways. That's right. RBC, TD, BMO, CIBC, and Scotiabank all buy mortgages from these small lenders because the quality of the clients is so good, and you can get significantly better products from these lenders than you could with the same banks that you're funding right now. Think about it. These non-bank lenders wouldn't exist if they didn't have a better product. They have to be better to survive, because if they weren't, everyone would go straight to their bank. So let's break down the seven lenders you need to know about. The big five banks plus the two biggest monoline lenders in Canada. Let's start with the big five banks, ranked from least features to the most features. Start with RBC. RBC is the biggest mortgage lender in Canada. Great bank. We do commercial banking with them. But their mortgages, they leave a lot to be desired. Here's what you get: only 10% lump sum payments per year, and you can only use it once. They do allow you to do double up payments, which is good, but they have very high penalty calculations if you need to break your mortgage early. And here's the kicker: RBC never offers you the best rate upfront. They're trained to tell you if you go and find a better rate, we'll beat it, which means they could have given you a better rate from day one, but they chose not to. I'm not a fan of that approach. CIBC, a little bit better. You get 10 to 20% lump sum payments depending on your mortgage. You get 100% payment increase options, but still, those high penalty calculations. One thing you need to watch out for: CIBC loves to offer cashback mortgages. Sounds great, right? But you're paying for it with higher interest rates. And if you try to pay back that mortgage even one day early, you have to pay back the entire cashback amount. It's a handcuff, so be careful. Next is BMO. BMO has 10 to 20% lump sum payments and 10% to 20% payment increases. But here's what you need to watch out for: their smart mortgage, it often comes with a lower rate, but it's what we call has what we call a bona fide sales clause. That means you cannot leave BMO unless you actually sell the property. You can't refinance, you can't switch lenders, you're stuck. And for most people, this isn't a problem. But for the people where it becomes a problem, it becomes a very big problem. You get what you pay for. Now, we're getting into lenders that work with brokers. First, there's TD, solid mortgage. 15% lump sum payments, everyone gets the same, no special treatment. 100% payment increases, but those still have high penalties. Here's what concerns me about TD: They have something called TD mortgage prime rate. Back during the financial crisis, they didn't pass on the full rate reduction to mortgage clients. They kept about 15% of the percentage for themselves. So, what that means is if you had a TD variable rate mortgage, you were paying more than everyone else in Canada. And that's still true today. What's to stop them from doing it again? Scotiabank is probably our favorite lender, a big bank. In fact, this is where I personally have my mortgage. I'm a mortgage broker. I could get my mortgage anywhere, but I chose Scotiabank because they have the best overall products of all the big banks. And here's what you get: 10 to 20% lump sum payments per year, 10 to 20% payment increases, and double up payments on top of that. That means Scotiabank has the absolute best prepayment privileges of any big banks in Canada. You can pay off your mortgage faster than anywhere else. They also have skip a payment option if you've paid ahead. Great for self employed people or if you love to travel. And here's the big one: Scotia offers adjustable rate mortgages, not just variable rate mortgages. That means your payment adjusts as the rate changes, so you avoid payment shock when you renew. This is huge. Now, before we get into the monoline lenders that often beat big banks, if you're watching this and thinking, I need to know if my current mortgage is costing me money, click the link below and book a call with me. We'll look at your scenario, see if we can restructure your payments, and figure out how to get you mortgage free faster. Links in the description. All right, let's talk about two lenders most Canadians have never heard of, but should have. These are A plus lenders. They take only the best clients, and they're funded by the same banks we just talked about. First up is MCAP. MCAP is one of the biggest non bank lenders in Canada. Here's what you get: 20% lump sum payments, as many as you want on your payment date, 20% payment increase, no double up payments. But here's the big thing: their mortgage penalties are significantly lower than any big banks. And this matters because 60% of Canadians don't make it to the end of their 5 year term, and almost all of them pay a penalty. The penalty is the single highest cost associated with a mortgage, not the interest rate. So when you're choosing a mortgage, look at the penalty first, then the product, then the price. MCAP also offers adjustable rate mortgages, which are compounded semi annually, like a fixed rate, not monthly, like a variable. That means even if the rate is the same as RBC, CIBC, you're paying less. Next up, we have First National. This is one of our favorite lenders in Canada. They have some of the best products and services and really good prices. And our clients really love them. Here's what you get: 15% lump sum payments per year, 15% payment increase, double up payments, and significantly lower penalties than the big banks. And here's the kicker: if you have an adjustable rate mortgage with First Nat and you decide to lock in, you lock in at their best rate, not some negotiated rate between what you're paying and their posted rate. That's huge. Between First National, MCAP, and Scotiabank, these are the three lenders most of our clients choose. It's about a third, a third, and a third. And what's interesting is that clients will often choose to pay a 0.1% more to have one of these premium lenders than they would for RBC or CIBC. Because when they understand the features, that 0.1% is worth maybe a cup of coffee a week. But the reduced penalties and better prepayment privileges could save tens of thousands of dollars over time. So here's how I break it down: top tier best features, First Nat, MCAP, Scotiabank. Middle tier decent, but watch out, I would say TD Bank. Bottom tier, proceed with caution. RBC never offers the best rate up front. CIBC has the cashback handcuffs. BMO has the bona fide sales clause. Now, this doesn't mean you can't get a mortgage with RBC, CIBC, or BMO. but you need to know what you're getting into. You need to understand the handcuffs, the penalties, and the restrictions because the wrong mortgage can cost you tens of thousands of dollars and years of extra payments. Here's the thing, most Canadians think the interest rate is all that matters, but it's not. It's the penalty first, then the product, then the price. Because if you get stuck with a $15,000 penalty because you need to sell your house or refinance, that 0.1% lower rate got you what? It cost you way more than you saved. And if you don't have the prepayment privileges to pay down your mortgage faster, you're leaving money on the table every single month. The right mortgage with the right features can help you become mortgage free faster in 5, 7, or 10 years. And that's what we focus on. So if this helped you or you found this valuable, please hit that like button, the subscribe button, and hit that little bell. And if you want to book a call with me or someone on my team to learn how we could restructure your payments and see if we can pay off your mortgage sooner, click the link below in the description and book a call with me. It'll go directly into my calendar and we'll meet on a Google Meets. Whether you're a first time home buyer, renewing, or just wondering if your current mortgage is costing you money, let's talk. Because the right mortgage can change your financial life. Thanks so much for watching.